I honestly believe $8,000 gold. People say, "Oh, how can you get?" Well, okay. Well, we figured 4,500 gold by the end of this year, and that was only at it was 2,900 or whatever it was.
Yeah.
I mean, you start breaking some of these barriers, and the race starts to really accelerate. You can't print silver. You can print more money to buy more gold at a higher price, but there just isn't the silver there. It's just not there.
Yeah.
So how the hell are they going to extricate themselves from this position? That's why they're in backwardation into a delivery month. Where does that extrapolate out?
Yeah.
To me, it's $80. I mean, what, we're $2,000 up from, we're like $23 higher than the beginning of the year, over $1,500 higher in gold for the beginning of the year. I mean, you only have to step back and look, take the chart chatter out of it.
In this powerful market breakdown, metals expert Andrew Maguire explains why gold and silver may be entering the most explosive phase of their bull cycle. The recent surge in gold has already shattered long-standing resistance levels, and once these barriers fall, the pace of the rally can accelerate far faster than most investors expect. What makes this moment truly historic, however, is silver's structural scarcity. You can print new currency and manipulate paper markets, but you cannot print physical silver, and the physical supply simply isn't there to meet global demand. Major exchanges are now showing signs of stress, with backwardation appearing right into key delivery months. That's a signal that available metal for actual delivery is drying up, even while spot prices continue to climb. As gold pushes toward higher levels, the pressure on silver tightens, potentially setting the stage for a rapid move that could push prices toward levels few believed possible. This interview explores why the metals market is no longer a slow grind. It's becoming a race. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
Exactly. So now you've got all these institutionals. Now, the interesting thing is they can't necessarily buy physical. They're buying the ETF. Now, you and I are great. We don't believe in the last place I want to go and buy gold is an ETF. However, they have no choice. So, but because they're buying for keeps, they're not going to take delivery. They are going to own that position, and it's sticky. They cannot be rinsed. You cannot say, and in fact, you drop a price down, they'll buy more because they're buying more every day because they're moving from zero allocation to 20 to 25% and more in some instances for obvious reasons. So therefore, people look at it and go, oh, look, there's all this open interest building in the ETFs. It's not speculative. This is sticky stuff. And obviously the physical market is all we care about, but it actually is forcing, even though there's shorting going on in the GLD and one thing and another, it's still a physical market. And it's the physical supply demand is being set outside of the LBMA ring fence. Mm-hmm. And so therefore, it's back to same as silver. If I have a bar and I have to own it before I can sell it, I need a real price. I want a real price. So I will only sell it to you. And the more you want, the more I want. So you've got backwardations in December, although the next liquid contract is March. But when you look at, silver, sorry. So, but then if you look at January, that's already in technical backwardation. Mm-hmm. So it is happening. It is happening already. And now we're talking about 2026 and they're not even done. I think this morning I looked, there was still, 2,000 odd tons of, silver warrants floating around in there. And the thing is, there's a lot of people that I know and who are saying, well, yeah, we bought and we're taking delivery. We are taking delivery. Mm-hmm. Why? Because it's the only source of physical that I can get to my limit, to my actual limit. I can buy that. And so if that's the only source of physical, going to be banging on that back door, out it goes. So how can that possibly be, and that's mispriced. It's so grossly mispriced. And furthermore, even if it was more expensive, people would still be lining up to get it because there's not enough on offer to meet all the demand. So it is a toxic mix. And as I say, that's why I think these guys are like rats fighting in a sack. If institutional buyers are in there, and I would forget everyone else in Asia who views it differently to people in the West have, but need that exposure, then obviously, as far as gold's concerned, then they've still got to allocate more and more and more. The price is inelastic. It doesn't matter. They're just going to dump more dollars and get that exposure because we'll go out of risk into cash and into gold. So that demand there is competing with Asian demand, and it's setting a physical price. So I can't see. I honestly believe $8,000 gold. People say, "Oh, how can you get?" Well, okay. Well, we figured 4,500 gold by the end of this year, and that was only at, it was 2,900 or whatever it was.
Yeah.
I mean, you start breaking some of these barriers and the race starts to really accelerate. Now, as far as silver's concerned, how? I mean, we've already talking about a supply deficit. Now you're talking about the AI boom. So even if there's a slowdown, you have to look at the market. As overvalued as it may be, AI is going to require a lot of silver. Photovoltaic, we just talked about, photovoltaic supply.
Yeah.
Again, we're talking about 20 tons for each gigabyte. Everyone wants green energy.
The precious metals market is entering a new phase as institutional money floods into gold exposure, even though many large investors cannot buy physical bars directly. Instead, they are forced into ETFs, creating a surge in long-term sticky positions. Unlike speculative trading, these allocations are permanent. Institutions are moving from near-zero allocations to as high as 20-25%, transforming the entire demand structure. This isn't hot money. It's committed capital that won't be shaken out by price dips. But the real story remains in the physical market. As global supply tightens, backwardation is appearing across multiple delivery months, revealing severe stress beneath the surface. Investors seeking real metal are increasingly turning to the remaining sources capable of fulfilling delivery limits. In a market where buyers must own physical before selling it, true price discovery emerges, and it is far above today's quoted spot. Meanwhile, silver faces a perfect storm: an entrenched supply deficit, surging photovoltaic demand, and a rapidly expanding AI sector that requires enormous quantities of highly conductive metal. Even if broader markets slow, the long-term industrial build-out won't. With physical availability shrinking and institutional demand rising simultaneously, prices become inelastic. Capital will continue flowing out of risk assets into cash and ultimately into gold and silver. With these pressures converging, the path toward dramatically higher metal prices becomes increasingly clear. Let's get into the interview.
I think silver is the Achilles heel of this same group of people. RPMCL are just the four banks that basically control the cartel, basically. And I think their liquidity is completely blown to smithereens. All the institutional guys, as we've just said, they've exited. And now you can still access, as an institutional trader, I can then go in and tag the SGEI gold corridor, which is opening up big time, can access an increasing number of vaults, gold and silver that can be traded with a real physical price that is much more stable than this unbelievable paper toxic mix that is thrown in. And it only serves. And I think the reason that we're seeing less volatility and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets. And if I'm a producer or a refiner or something, why would I want a price that's so volatile? I just want to know supply demand. People are owning a bar before it's put for sale. You have to own it before you can sell it, which tells me that if you put it up for sale, that's a proper price. I don't care what that price is. It's the proper price.
Right.
It's not COMEX-derived price. It's a physical price based on supply demand on the day, based on purely on that supply demand. That is how markets are supposed to trade. And we've been gaslighted, or many people have been gaslighted into believing that this huge COMEX volatility is the market. It just amazes me.
Silver has quietly emerged as the Achilles heel of the small group controlling the cartel, traditionally dominated by the four major banks. Institutional players, having largely exited the paper market, are now accessing physical gold and silver through new corridors and vault networks. This shift is changing the market structure dramatically. Prices are no longer being dictated by paper derivatives or excessive leverage. Instead, they reflect real supply and demand, giving traders and producers a far more stable and transparent price mechanism. The liquidity that once fueled extreme volatility in COMEX contracts is largely gone, absorbed into physical markets. With metal ownership required before selling, each trade establishes a legitimate market price, free from manipulation. This fundamental shift means large, abrupt sell-offs are far less likely, as the speculative, toxic mix of paper contracts has been drained. For producers, refiners, and long-term holders, this transition is crucial. Knowing that prices now represent true supply-demand dynamics allows better planning and confidence in the market. Silver's industrial demand, coupled with its role as a monetary metal, continues to underpin a strong, sustained, bull trajectory. The takeaway: physical silver and gold are taking control away from traditional paper market players, creating a more resilient, long-term foundation for investors. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.